Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today, talking about an Aussie stock, the only Aussie stock in the eToro portfolio, which is available publicly. And so we're going to talk about Whitehaven coal today and why I am finally allocating some capital. I've spoken about it before. If you're a member of the ROI channel, you know the stock was recommended at the end of or at the beginning of its run up. And so you would have done quite well. And if you haven't already seen my interview with Emmanuel Datz on this channel and the ROI podcast, make sure you check that out. This is the feature stock that Emmanuel spoke about when we had a chat last year. So disclaimer, guys, nothing here is advice. This is just my opinion. You need to seek your own qualified financial advisor before making any decisions. That's not me. I'm not qualified to give advice of any kind. I just do me and I share what I'm doing. So that's that. Okay. If you want to get access to how I'm personally leveraging these types of play, and Whitehaven is something that I've traded some options and done fairly well with, then you might be interested in joining or taking a free trial of my Substack private group, which is the Options Maverick. It's a group where I show you how I've generated income by essentially running a one-man insurance company. I sell insurance or options over publicly traded stocks. This year's year-to-date annualized record is 31% up, and it's not going to be me teaching you via videos or anything like that. It's going to be me sharing exactly what I do. And so, yeah, the premium members get access to that at least once a week. So all going well, fun stuff. Moving on, here is a one-page overview of Whitehaven as it currently stands. Remember, we're talking Aussie dollars as it's listed on the ASX. It's had a big 52 weeks, as you can see there. A few things to note, I guess. The share count has been reduced with a buyback program, very large. I believe the largest buyback program in ASX or Australian history last year when they put that through. So you'll see the market cap is above the enterprise value. What does that mean? It means they've got more cash on the balance sheet than they do debt, and they have quite a lot of cash on the balance sheet. So that's the main thing that I would be looking at when it comes to Whitehaven. We've got a target price for the analysts of $8.33, where it's currently trading in the $6 range. I believe it just finished today, end of day's trading. Market cap, the free cash flow at the moment, valued at about 3 times. So if you believe that, what that is essentially saying is the market believes the terminal value of these cash flows that this company can produce is suggesting that the company's going to end, or those cash flows are going to end in 3 years. Okay. So if you believe the company's going to go out of business in 3 years, it's going to be fair value. If you don't, then you'll be getting your investment back in 3 years, all else being equal, and then continuing to receive the cash flow streams after that. Price chart. So if we take a 12-month historic view, we had this massive run up on the back of record coal prices, obviously. And then we've just seen things start to peter off. And so basically, when we look at the next chart, this is the Newcastle coal futures. You saw this massive run up, and now we've dropped back down from a peak of over $440 US a ton, which is a lot. We're now trading at around $134 a ton. So there's still some, I guess, some room for downside, but the world we were in back here in 2019 is very different to the world we're in now in terms of 2023 moving forwards in terms of supply and demand. There's not the same supply. It's much harder to get, or impossible in Australia, basically, to get new mines out there. If you haven't already got that mine permitted, good luck getting it through, given just the new legislation around coal mining at the moment. Which just seems to be tightening supply from all around the world. Back of the envelope valuation before we look at the corporate presentation for this company, because there's a lot of gold, a lot of coal or gold in the corporate presentation. I think it was a really good one from Whitehaven. So at 678, we've got $1.16 in cash in the bank accounts of the company. So that's worth noting. If you just take analyst estimates for next year in terms of EBITDA and free cash flow on a per share basis, this is where you're looking at. Now, what multiples should we apply low ones, basically, because it's such an out of favor sector. Some people might argue, well, a 1x multiple, because in this type of play, you're getting your money back and earning its way out. It's unlikely that the popularity of coal is going to change anytime soon, and institutions are going to come in and bid that up. So there might be that argument. I look at it and say, well, I'm happy to get a 33% free cash flow yield is very, very good. I don't believe coal's going anywhere in the next 3 years. So 2 and 3 multiples are reasonable from my perspective, my opinion. And then if we have an equally weighted average, expected target price on the upside for Whitehaven, somewhere around $9.93 Aussie, giving no credit for buybacks or dividends or anything like that. Okay, so from the enterprise value, so if you were to subtract $1.16 from $6.78, you're looking at maybe a 52% upside from an enterprise value perspective. So I'm just going to make note of a few things. I was going to copy and paste them or screen grab them and put them across, but it doesn't really make sense. Let's just take a look at the corporate pres here. So these are the forecasts long-term that Whitehaven are using for their business models. Okay, so for your thermal coal, they're looking at from financial year 23 onwards, they're modeling around $106 a ton, okay, as a blended price. So that's interesting. And that is what I'll be then using for my modeling. So we're at 133 now. We have been up at as high as 440, which we saw before. I think $106 per ton is a very conservative figure. So I think, you can be quite comfortable going with that. As you saw here, this massive run up in coal demand, it was spurred on by the war in Ukraine. It wasn't caused by it, and as you can see here, we had some run up prior to the invasion. Missing the market view. This is important because if we take 106 as our price, that's super conservative. We may see several spikes of a couple of $100 coal over the next few years. Why? Because normally energy needs are preferentially used by natural gas, but natural gas, we've got a bifurcation from supply chain impacts in Russia. Then you'll have to have the infrastructure for natural gas. It's very difficult. Whereas all these holes essentially will be plugged by coal, because you can just throw it on a ship or throw it on a railroad and deliver it and get quite decent energy density from coal. So coal demand is not falling like people believe in the West. We just think because we're trying to ban it that everyone else won't use it. But if you're looking at these imports, like 2023, look at that from China, India, and others. It's massive. So we continue to see emerging market growth and emerging market demographics hit their growth curve in terms of the amount of energy they use. And coal is going to be the lowest hanging fruit in order to hit those before countries like China can roll out their 150 nuclear reactor plans and all these sorts of things. People are going to fall back on coal because it's at the moment, it's cheap, it's easy, it's efficient, it's effective, and it's readily available and ready for transportation without specific infrastructure needs, like, for instance, the case of natural gas. A few things to point out. Infrastructure and domestic demand in South Africa means that less coal will be exported, so there'll be a lot used domestically, but that will take away the supply from the international market. Okay, Russia being sanctioned, so they're out of action. It just looks to me as if the supply fundamentals are going to get better and better from an investment perspective. Not very good for energy bills, let's say, but I think coal prices will continue to rise on the back of that. And this is a risk that all mines in Australia basically have at the moment. We're copying Chile in terms of some of the things we're doing. But anyway, so one risk I want to point out is that royalty or windfall taxes are a real thing, as you've seen with the offshore and hydrocarbon producers in the UK with their windfall tax. This is a risk that needs to be pointed out. It's hard to it's hard to really put a probability factor on. But in Australia, if you're not familiar with Australian politics, we have federal elections every 3 years. So if you were to see a case where someone would slap a heap of royalty taxes on, which has happened already, then you'll have obviously less incentive for development of new supply. These companies then aren't going to open up or develop new mines. They're not going to do any more acquisitions. They're going to buy back their own stock or pay out as dividends, which we've already seen. And they're going to defer investment until they're happy with the regulatory environment. So whilst those royalty taxes can be a pain in the butt right now, a few points, because of that 3-year election cycle that I mentioned, that can change fairly rapidly. And whilst that's in play, think about what's happening to the supply side. Well, of course, the supply is just going to be continuing to shrink. Okay. So if you've got a longer term view, although it's quite annoying because a lot of these companies will probably reduce production, or they certainly won't invest too much in new CapEx, they will essentially be deferring that CapEx, deferring production for the future. And so you're going to get a supply crunch, which may well lead to, over $300, $400, $450 a ton for coal. I mean, it could happen. This is interesting. I'll point this out and then I'll move on. You guys can read it at your own time. They've done a few different models, and when you're looking at cost increases and the unit cost of Australian producers, you've got Whitehaven here, and you've got all the other names. There aren't too many other coal names left. It's interesting to see how, when they've modeled some of these developments, what that impact to the seaborne market would be. So Canada, and particularly, like, no thermal coal exports, this idea by 2030, 20 metric tons of supply gone would be the implication of that. And so when you start to look at just the amount, the sheer volume of coal that could be taken off the market, well, this just looks even better in terms of, if you can find a producer that's likely to survive, and you probably need to take a basket approach, I would suspect. That's what I'm doing. Then you should be able to find at least one winner amongst a basket. So I've spoken about Yancoal and Glencore before on the channel, as well as Peabody. And so today we're just taking a closer look at Whitehaven Coal. The rest, there aren't that many horses left in the race. Global trade, we talked about that. That'll be interesting from a tanker perspective, but ships at the moment are killing my portfolio, my private portfolio anyway. Petrobras has saved it and delivered quite good returns, but ships we won't talk about right now. Same story: demand growing, supply contracting, and this kind of model here is something you may want to check out on your own time. So even with the worst of all worlds here, we're going to see an increase in terms of demand versus supply. And when you're looking around that $106 US a ton, even in the worst case environment, that seems to be a good floor in terms of a conservative floor to set your assumptions. So that's what I've done. Okay. Final point here through the quarterly report is just to look at guidance. So anywhere from 18 to 19 metric tons expected for the year. What does that mean? So what I've done here is model out the year at the top, and I've used 18 as a flat volume. So a stay flat volume. Let's say they just can't get their act together and grow production, which this company does have the ability to do. They've got some new mines coming on as of the end of this year, I believe. And here you've got sale price, not this year because they can achieve higher than that, but as of next year onwards, I've just modeled that $106 US a ton and used today's exchange rate. So obviously it's subject to Forex. But if you were to take that, you'd be looking at revenues coming in at the end of this year in Aussie dollars, 6.3 billion, plus over 2 billion in cash already on the balance sheet. If you said that this company if you would assume a very conservative free cash flow margin of 20%, so that's really not doing them justice for this year, but moving out with a lower coal prices and a higher cost input expected into the future, it seems to be, again, a nice way to be fairly conservative, in my opinion. We get a free cash flow, and then we get what would happen if the company buys back 10%, uses 10% of that free cash flow to buy back stock. Now, Again, that's conservative. Why? Because Whitehaven have said between 20 to 50% of their NPAT will be used as a shareholder return program. I'm putting in a little safety mechanism for if they decide to change their mind and do some sort of, I don't know, crazy acquisition or who knows what. So 10% seems reasonable. And then on a per share basis, this is what you'd be looking for essentially as a free cash flow metric down the bottom. So $1.49 for this year. And then I'm having a share reduction if they were to buy back sort of, call it 10% of the float year on year, which could be quite feasible. If you look at free cash flow to enterprise value yield as of next year, or as of the end of this year, I should say, 26.63%. Moving to the next slide, if we've got the market cap today, so ignoring the cash on the balance sheet, using a discount rate of 12%, which is quite a long way ahead of their weighted average cost, not of capital, of equity, really, which, I think it's a bit silly to call it cost of equity. It's not costing the company anything really. In real terms, it's a company without any debt. But anyway, we've got to pick a discount rate. So I'm using 12%, and I've taken those cash flows on a per share basis and then discounted it here today. And we're looking at an IRR of around 12.6% in that conservative, very conservative scenario. If you were to take the enterprise value and then discount it back, again, using that very conservative model and ignoring the cash buybacks, you'd be looking around 17% IRR. So pretty conservative valuation to get quite a decent return in what will be a difficult environment, I believe, moving forwards to get a high rate of IRR. And so I think Whitehaven is very, very interesting from an investment perspective. The risks, commodity price, of course, if we really just, for whatever reason, coal price plummets, you'll be waiting a while to get the return on investment. But having said that, the company does not have any debt. They've got a large amount of cash. And given the supply dynamics that I've spoken about for the energy sector ad nauseum over the last few years, I don't expect that to be the case. Production risk, this is more of an issue. So if there's bad weather and a mine has to shut down for a quarter or however long, you're going to see a decrease in production. They can't sell as much coal, obviously. Labor is really, really, really tight here in Australia right now. It's ridiculous. Paying a tradesperson like triple figures for a call-out fee, all this sort of thing. It's super, super tight. Taxation, who knows what's going to happen with that? It's a risk on there. Just got to keep an eye out, I suppose, and take more of a basket approach. So personally, I've invested in different coal companies: Yarncoal, Peabody, Whitehaven, Arch Resources, Coronado, and Thungalla. So I've taken a bit of a basket approach in different jurisdictions, hoping to avoid any idiosyncratic risk where one particular government decides that they're going to come after a coal company. So I'm accumulating Whitehaven as part of the portfolio. It's got a margin of safety. Coal prices are around where they were in 2011, but the supply-demand picture is very, very different. Look, I think if you can, I'm happy if I can earn my investment back from cash flows in 2 to 3 years. I view it just like a private business acquisition, but I don't have to worry about the operations. So that's always good. At the dawn of a commodity bull market, shareholder return programs in place. So it'll be 20 to 50% of NPAT, either via dividends or buybacks or a combination of the two. I will be building this in the Crassus investment portfolio to at least 3 to 5% of assets under management. And so I will have a scenario where Peabody, Whitehaven will make up for sort of blended or slightly more thermal coal producers. And then we have Arch Resources for mainly met / coking coal. For the steel to make all the wind turbines and electric infrastructure that these governments want to implement. That's that for today. By all means, copy the portfolio if you've got some funds and you like the investment approach and you just want to put some funds away for hopefully growth over the long term. Otherwise, please do like and subscribe to the channel if you're interested in reaching out to me on Twitter at the ROI channel. And of course, if you're interested in how I'm trading options over Whitehaven to really get the juice out for some income, the link will be in the description to the Substack group, Options Mavericks. Otherwise, guys, take care. Remember, do your own due diligence. It's not advice. And I look forward to catching up with you in another video